Welcome to Financial Perspectives, the podcast, where we cover timely topics related to the current economic environment and keep you up to date on investment news. We also provide insights on how investors can maintain a long-term perspective. Please stick around at the end for important disclosure information. More information about Foster Group can be found in our ADV brochure at fostergrp.com.
Hello, and thanks for joining us for a special Financial Perspectives episode. Time seems to speed up at year-end, and December 31st can sneak up on us before we know it. As we approach the year-end, there are some opportunities for tax planning still available to us, but if we're not aware and prepared to take advantage of them, well, these opportunities to impact our 2024 tax liability may slip away. And even if we're not in a position to do something this year, we can begin to prepare for 2025 and future years starting now. Recently, I had conversations about year-end planning with Foster Group advisors Marcus Iwig and Caleb Brown. Both Marcus and Caleb work with families and individuals with whom they have developed well-thought-out personal goals and plans. And at year-end, many times, income, investment, and tax circumstances just create some interesting opportunities to enhance the effectiveness of these plans. Marcus's background as a CPA and experienced advisor gives him unique insight. Caleb also has deep experience as an advisor and can combine detailed tax and planning analysis with understandable action steps. I enjoyed the conversations, and I hope you'll find them helpful in your year-end planning as well. Marcus, welcome.
Thank you, Ken. Happy to be here.
Thanks for being here. Well, as we talked about, there's always plenty of things to consider at year end, but when we were talking about what we might talk about today, you had mentioned this thing called qualified charitable distributions. And it's something that really could apply to a lot of folks out there. So why don't you tell us a little bit about what that is?
Yeah, a qualified charitable distribution is essentially a gift that comes directly out of your IRA to an end charity. So this is as opposed to taking money out of your IRA, putting it in your bank account, and then writing a check to charity. Now, there's a few quirky rules with this. One, you have to be 70 and a half. We don't like nice round ages. We had to go with a half, but nonetheless, it's 70 and a half. It has to come from an IRA. So despite 401ks and other retirement accounts looking a lot like an IRA functionally, the law says only charitable qualified distributions can only come from an IRA.
Okay, that's important.
Yeah, and then operationally, what's going to happen is you're going to make this request of a custodian that holds your IRA, places like Schwab, Pershing, Fidelity, and they're going to issue a check directly out of your IRA to the charity. So you're going to get a check made out to the charity in the mail.
Okay, so the charity actually receives a check from your IRA directly.
Correct.
That's the idea.
Yes.
So you mentioned IRAs. So is this, and not 401ks, how about a Roth IRA? Is that?
No, you're not going to use a Roth IRA. There's no tax benefit. We'll get to that in a little bit, but because those dollars are all after tax, and this might become clear in a minute, you're not going to get an advantage from doing this out of Roth IRA. Just a regular pre-tax IRA that's going to be called either a traditional or rollover IRA.
Okay, perfect. So a lot of us have those things. So this is kind of a opportunity really for many people to do that. Sounds pretty easy to do, at least if you qualify.
Yes.
That 70 and a half number. What are the tax advantages really for doing it this way?
Okay, we're going to get in a little bit of complexity here. This is the fun part, right? But it really comes down to this idea of a standard and itemized deduction. There's other benefits, but this is really where you get the most bang for your buck. And essentially what we're going to do is shift our mind from increasing our deductions to reducing income. And you're thinking, isn't that the same thing? And in a way, yes, but no, when it comes to filling out your tax return. So when you think about filing your taxes, you add up all your income, and then everybody who files taxes gets a deduction. And you're either going to get a standard deduction, which everybody gets, or an itemized deduction. An itemized deduction is a summation of all the itemized deductions you can take. If it exceeds the standard, then you take that. Well, right now, the standard deduction for anyone over 65, because that's the group we're talking about, is around $16,000, $32,000 for a married couple.
Okay.
That's a pretty high number for someone over 65 to exceed with itemized deductions. Other if you think about the itemized deduction categories, there's charitable gifting, that falls into it, mortgage interest, state and property taxes, which is capped. We'll stay away from that, but there's limits on that. And medical expenses, which is also not a dollar for dollar deduction. So it can be pretty hard for somebody over 65 to have itemized deductions over $32,000. So let me use a real example, if that's okay.
Yeah, great.
Very simple, but it'll make a lot of sense, I think. Let's say you and your neighbor both take $100,000 out of your IRA to live off of, and your neighbor spends all of it to travel and do all the things they're doing in retirement, and you spend $80,000 of it on those things and give $20,000 to charity. So you're both taking $100,000 out, putting it in your bank account. You're spending $80 on yourself and your spouse and the things, and $20 is going to charity. Well, it's very likely that your itemized deductions, even with that gift, don't exceed that $32,000 standard deduction. So your tax is $100,000 minus $32,000 for the standard. So $68,000 is your taxable income. Well, guess what? Your neighbor's is too. $100,000, even though they didn't give any money away, they get $32,000 as well. So you both have taxable income of $68,000. I'm not here to say what's fair. I'm not sure I feel great about that if I give $20,000 away. So now let's do this just a little differently. We're still going to give $20,000 away, but instead of taking the cash into the bank and writing the check, we're going to request that check from our IRA now. Now this gets back to my statement about reducing our income, because what the IRS says is if you do it that way, instead of reporting $100,000 of income, I now get to report $80,000 of income. That $20,000 doesn't even show up as income. And guess what? You still get the standard deduction of $32,000. So now your taxable income is $48,000, right? 80 minus 32, and your neighbor's is 68. I feel a little bit better about that if I gave $20,000 away, and that's probably some measurable tax dollars saved.
Yeah, that's great. And you also mentioned, I think, when we talked about this, that it has a positive impact potentially on the Medicare income calculation.
Yeah, this one's a little less thought of, a little more indirect, if you will. But your Medicare premiums are based on your gross income from 2 years prior. So not including your deductions, just the summation of all your income. And the Medicare premium is based on that income, and it's tiered. So if you reach certain levels of income, then your Medicare premium goes up. So this is highly individual. It's specific to individuals. But if you're pressing one of those limits, it's possible by giving directly out of your IRA and not having that as income on your return, it could help you keep your Medicare premiums down.
Yeah, it's just kind of a smarter way to think about, hey, what's going to help keep me underneath or from triggering an increase in Medicare that I wouldn't necessarily have to have if I did charitable giving in this way.
Absolutely.
Yeah, it's really a great tool. And I think for people who are thinking, at the end of the year, maybe we have some additional charitable gifts we'd like to make. We have access to an IRA. We're over 70.5. This is really kind of the place to start, is what I hear you saying.
It is. It's one of the more powerful tools we have at our disposal these days.
Yeah, fantastic. So for you and I, we're sitting here. We're not yet 70.5, at least what I can tell.
Yeah.
I know about you anyway.
Thank you.
I'm getting closer.
Yeah.
But for those of us who are not yet 70.5, but have some maybe charitable intent here and charitable things we want to do at the end of the year, what should we be thinking about in terms of kind of that whole thing around the standard deduction and what that means for us as maybe people who are giving at the end of the year?
Yeah, great question. So this gets to a concept called bunching our gifts. This is essentially being able to get credit for 2 or 3 years of charitable gifting in a single year. So we increase our itemized deductions measurably above that standard limit. And then the following year, we take the standard deduction. So the way to do that, there's some tools out there. We won't go too far in the weeds today, but a donor advised fund. A donor advised fund allows you to set aside your giving into a fund that is a charity itself, get the credit for that gift on your taxes, and then ultimately direct that fund to give the money out to the end charity at whatever point you desire. So if you say, well, I give $20,000 away next year to church or wherever you might give money, but I'd prefer them to get it on a monthly basis, no problem. I can put my $20,000 in there before the end of this year and into the donor advised fund. And then I can have it issue a check to my church or other charities each month so that they don't feel a difference. They still get the money when they want. But I get an increased deduction this year.
Yeah. So the bunching idea, because you can do that for more than 1 year. If we put money into a donor advised fund this year, you could say, well, I'm going to give some this year and next year and the following year. So I think that bunching idea is, let's say that someone's going to they're planning on giving $15,000 a year, which any given year would keep them underneath that standard deduction.
Right.
But if you add up all 3 years, you get $45,000 worth of, intended giving,
Right.
which would get you above the standard deduction.
Right.
So if we give that in 1 year, okay, now I'm going to get to deduct that whole 45.
Right.
And you could give the whole 45 to those charities that you intend to give to right away.
Sure.
But you could also, like you said, put it into a donor advised fund and say, okay, I'm going to give $15,000 out of the fund this year, and then the following year, and the following year. So we kind of back up the deduction in terms of our taxes into 1 year, but we still get to give the gifts or have the charities receive the gifts kind of in the time frame that we had in mind. Or maybe things we don't know for sure what we're going to give to yet. We just have a plan for giving in the future, and we want to be able to kind of wait and see, well, what needs or what opportunities might come up.
Yeah, it's a really cool tool, and it creates a lot of flexibility for how you distribute the funds, but allows you to take advantage of the tax breaks without burdening your charitable organizations with gifts at times maybe they don't want them, or takes away that communication need that, hey, I'm giving all this big sum of money for next year right now, which just can feel awkward.
Yeah. No, I like it. Those are 3 great ideas. I mean, the idea of the qualified charitable gift, for sure, that is a big one, distributing from an IRA if we have charitable intent. But then this other thing around bunching and donor advised funds, as Marcus, as you said, this is one where you want to consult your advisor, think through those things, because not everybody has the same tax situation or the giving goals or even the opportunities maybe in front of them, based on account sizes or whatever.
Yeah, and it comes down to your tax situation and your cash flow abilities. It could be hard to set aside next year's giving if you're somebody that just doesn't have the cash to do that yet. But if you do, it could be a good opportunity.
Right. Yeah, these are great. So, well, hey, thanks for kind of walking us through these 3 things today. Super helpful. I'm sure a lot of people are thinking about, kind of like I am, okay, what do I want to do at the end of the year? I know Kim and I have really benefited from the use of a donor advised fund. It's been a tool that's been very easy to open and use. And so those are the kind of things that you and other advisors at Foster Group would kind of recommend for clients to consider doing. Hey, Marcus, anything else as we close here that you'd like to add before we finish?
I don't think so. I mean, I think it's important to know that these ideas are highly specific to the individual, and you should absolutely talk to your CPA or your advisor about them. But pretty exciting time to be thinking about charitable giving. So.
Yeah, that's great. Well, Marcus, thanks for joining us today and for sharing some of these practical ideas about how to multiply really the impact of year-end giving. So Caleb, thanks for being here, and we're looking forward to this conversation.
Yeah, me as well.
All right, so I've been in client meetings with you before, and you've talked about something called a Roth conversion. And for a lot of people, this really seems to make sense. Tell us a little bit about what is a Roth conversion.
Right. A Roth conversion is essentially you're just taking money from a pre-tax account. So it's like, think of your 401k, think of your IRA. You're taking it from that pre-tax and you're moving it into a Roth account. The Roth, once you do that, is essentially you're done paying taxes. So it's tax-free.
So just kind of frame that up again. Why is this so worth considering?
Right. So why would you pay taxes? That's the question.
Yeah.
Well, because eventually you're going to have to pay taxes on those pre-tax accounts anyway. So the bigger they are, the bigger that you're going to have to take out. It's called a required minimum distribution. So you can get ahead of that for one. But the other part is you just don't know what taxes are going to look like in the future. And so the flexibility behind that, the ability to have a tax-free asset that you can pull from in case of emergencies, or you want to take a big vacation, do something fun. You want to pass this to your heirs and not have them have any tax. So all sorts of great benefits with the Roth IRA.
All right. So you kind of started to touch on that a little bit. Who are really the best candidates? Who's going to get the most benefit from thinking about or doing a Roth conversion?
Yeah, the people who are going to get the best benefit are the people that are in the lowest tax bracket.
Okay.
Because you want to pay the least amount of taxes to do this if you can. And so you try to do that. Typically, what we call the opportunity valley, which is the time frame when you stop working, and so your income shuts off, and then before other income sources kick back in. Income sources could be Social Security, could be your pension if you have one of those, if you're lucky enough, not many people do anymore, or those required minimum distributions that might come later in your 70s.
Okay. So that makes a lot of sense. We've got this opportunity valley. Can you maybe give us a story of a client or someone you've worked with and like how this worked for them?
Right, yeah. Well, I try to do this as often as I can, the opportunity that lies. So each year we'll just look at client situations and to make determination, does it make sense to do it or not? There's a client I'm thinking of right now that we've done this with after he stopped working at a business, basically had no income at all. And so imagine if you have no income, you have no taxes, right? So that could be a win in itself, but what I would encourage and what we did do is Roth converting. So we just continued that process year in and year out. We've done that for a few years now and it's worked out excellently.
So he had no income tax liability. How do you determine how much of the IRA to convert? I know you've talked a little bit about, well, let's fill up a tax bucket, let's say up to a certain rate.
Yeah, so you got to be careful. You got to understand what is your income appetite. So for some clients, that might not be very much, and that's okay. But there tends to be inside of the tax code some pretty, what I call lower income tax brackets, and that's 10 to 12%.
Okay.
So ideally, you're doing at least that.
Yeah.
Then there's another section that's just above that's from 22 to 24%, more like a reasonable rate of tax. Historically, it's actually pretty low still. And so those two brackets, the kind of reasonable, the low, those tend to be what we're looking for the who makes good sense to do that for.
Yeah. So the idea there would be to convert as much of that taxable IRA, kind of creating income up to the top of that marginal bracket.
Right.
Like 22 or 24, something like that. Get the full bang for the buck.
If they're comfortable. Some clients still don't want to pay the tax.
Yeah, that's right. It doesn't feel good sometimes to say, so I could pay almost nothing, and you're asking me, would you like to pay some?
Exactly.
And the idea is, well, if you pay some this year, you may actually pay a little bit less on this income than if you waited and took it later.
Correct.
It might be more expensive.
Right.
Okay, that makes sense to me. How about unintended consequences? I mean, we just talked about income taxes as one thing to really pay attention to. What else might be an unintended consequence that people should be aware of as they think about a Roth conversion?
Yeah, so first thing I always like to say when you're starting to take income, and if we're recommending it, is talk to your tax advisor.
Yeah.
Because as you take income, that can trigger other things. So one that comes to mind right away is the Medicare. So if you're on Medicare, if you're past 65, Medicare Part B and Part D are income tested. So the more income you have, the more you're going to be paying those premiums. And so some people do not like that. So if we try to avoid that.
Yeah.
Also, if you're pre-Medicare, there are some tax credits if you're on the healthcare.gov, which is called the premium tax credit. And that is based on your income too. So you got to be careful with how much income you're taking. And then the other is taxability of Social Security. So if you do start to take Social Security after retirement, then what you're going to pay in taxes on Social Security is dependent upon all that other income. And so all these different, kind of moving parts, you just got to make sure you understand them before you do that.
Yeah, makes a lot of sense. Good strategy, but there's some cautions there. So the tax advisor is really important, as well as meeting with people like you. Say, let's talk through whether this is a good fit for you personally.
Right.
Yeah, good. All right. So this we kind of talked about if someone's maybe able to do that this year, this is what it would look like. What about people who can't do it this year? Maybe they're still working. Are there things they could be doing even now so that when that opportunity presents itself, it's just easier?
Yeah. So the one thing, if you think about that opportunity valley too, so you've got a window of time before income kicks back up again. That's those requirement distributions. Mm-hmm. And then you've got from when you stopped working. So what are you going to do in between there is you have to have something to live off of, correct? So think about what that might be. It could be retirement accounts, but it also could be cash or investment accounts. Things that are non-retirement accounts tend to be a really good avenue to pull from during that time. And so in order to have those, you got to start building those. And so I'd always encourage, even before 60, get going on some of those types of assets so that you're just more diverse when it comes to your tax situation. So that's one thing. Another thing, if you're in that opportunity valley, is you can push out Social Security. So if normal retirement age for Social Security is different for every person, but let's say it's 67 for you, 67 to 70, there's basically a bonus if you continue to defer it. And it's 8% per year on the benefit. And so the most you can get would be at age 70. So it makes sense to turn it on at that point. But in that time of delay, then that allows for more opportunity to do Roth conversions each year.
Right, because you've kept your income as low as you can.
Right.
If you can defer on Social Security, that's taxable income you're not receiving. I think that's a really good piece of advice, reminder as well, to like, if you can be saving some money, investing some money after tax, pre-retirement, then you've got a pool of assets to draw from. I know one of the other things about this that makes it a little bit easier and that sometimes we miss is the logistics of doing a Roth conversion is you can't do it directly from your 401k. You actually need to have those assets in an IRA. Is that right?
Well, it could be done in a 401k. Some plans offer what's called an in-plan conversion. But often what we're doing is it's rolling money from a 401k to an IRA. And then the Roth IRA ideally is either open already or we would create that. And so then we can just make that change. And that doesn't happen overnight. So a lot of times you want to be ahead of the game on that one.
Mm-hmm. So just something to think about in advance when you look at your retirement plan assets. Sometimes it's just logistically easier to say, let's roll some assets out of the 401k into an IRA where it's kind of easier to do that Roth conversion.
Correct.
And another conversation we had with Marcus, the other kind of advantage of getting into an IRA is if you're old enough to do qualified charitable distributions, they also can only come from a regular IRA as opposed directly from a qualified plan.
That's right.
Yeah. All right. Well, Caleb, thanks for this idea. This is kind of a good one for people to think about as you look at your year-end plans. I would encourage you to, again, talk to your advisor about whether this might make sense for you this year, or like we just talked about, maybe that you should be preparing to do this in the future and there's some steps you could take today to do it. So Caleb, thanks again for sharing this with us. We'll look forward to getting together with you again soon.
Yeah. Thank you, Kent.
All right. So there you have it. Both Marcus and Caleb shared some interesting ideas that you may be thinking could be applied to your situation. Now, as they both said, it's important to consult your tax professional as well as your financial advisor to understand if and when these strategies could really benefit you. If you're already a client of Foster Group and one of these has caught your attention, please contact your advisor. If you're not a client of Foster Group and would like to have a conversation with us, call or visit our website, www.fostergrp.com. You know, good year-end financial planning is yet another way to develop an educated optimism about your future. We prepare for every episode of Financial Perspectives, believing that educated optimism really is a cure for anxious uncertainty and leads to better decisions and lived experiences. In our next episode, I'll be having a conversation with Foster Group advisor Ashley Verriger about how to make generosity an activity for the entire family over the next couple months. We'll be applying the ideas Ashley shares in my own family as well this year, so don't miss it. And until next time, thanks for investing your valuable time and attention with us.
The previous presentation by Foster Group was intended for general information purposes only. No portion of the presentation serves as the receipt of, or as a substitute for, personalized investment advice from Foster Group or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy, or any non-investment related or planning services, discussion, or content, will be profitable, be suitable for your portfolio or individual situation, or prove successful. Foster Group is neither a law firm nor accounting firm, and no portion of its services should be construed as legal or accounting advice. No portion of the content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Foster Group is engaged, or continues to be engaged, to provide investment advisory services. A copy of Foster Group's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fostergrp.com/disclosures.